I think we're seeing now that this reliance on leverage and this reliance on asset prices, which has really taken hold over the past 40 years, it's really eroded the value of money. And again, I think this began in sort of 1980, but you've had different iterative stages, primarily depending on the central banker in charge. But in this recent book, The Lords of Easy Money, there's a passage where they talk about how with the dot-com bust, the Fed sort of justified cutting rates aggressively as a means of enhancing availability of housing to kind of lower income stratum. And here we are 22 years later, and they've essentially achieved the exact opposite. And that's because, incentivizing demand didn't really help the supply side of the equation. Again, I don't want to read too many numbers, but even, when I say different iterations, I think COVID sort of marked almost like a euphoric blow off. And again, this is a statistic that is mind-blowing to me, but from the onset of COVID through 2 months ago, we saw $30 trillion in global monetary and fiscal stimulus that was created, which led to $60 trillion of gains in financial assets. And as we both know, the majority of that matriculated to the wealthy, and just sort of extended a problem that was there. I think you and I had this discussion, which I'm not sure if it's a good parallel, but it's like when university Greek systems kind of got themselves in trouble with each each successive decade, and it started as an innocent toga party, turns into something worse, and then the new president doesn't they won't be voted in if he takes that away, so they have it and it becomes even worse, and each person's kind of painting themselves into a different corner.
Yeah, and it becomes more normalized over time because people just accept that that's acceptable behavior.
Yeah, exactly. And so that's, I almost feel sympathetic for Powell, because financial assets today are over 300% of our global GDP, and that ratio was 90% 30 years ago, and also during that same period, U.S. debt has grown 30x, and now surpasses 30 trillion. And I think really importantly, U.S. household wealth per GDP is now 590%, which is essentially double where it was 30 years ago. But as we both know, that has really been unequally distributed. And now you have the savings glut, which there's a lot of economic studies demonstrating that that has sort of this distorted impact on the economy. So yeah, I think you look at these numbers and you look at the fact that whereas between that 1950 to 1980 period, we required about 1.75 units of debt for each unit of GDP. That number today is 5x. And equities now, well, I'm not sure as of today, but as like 3 months ago, for the first time in 40 years, equities had become American households' largest, basically, source of wealth. And so, yeah, you can see this economy that's it's asset owner heavy, it's capital owner heavy, and it's sort of labor light. And yeah, I think there will be a reaction to that. And I think we've seen already, groups like the Business Roundtable who have come out within the past 3 years and shifted their ethos to favoring stakeholders rather than shareholders. And I think things like ESG as well are favoring this. And now we're beginning to see the upshot of this on the wage side as well. I think the last thing, again, sorry to throw just so much data at you, but I think it helps paint a picture. Family income in real terms is about 200% higher than it was in 1950 for the 95th percentile, or the 5% wealthiest Americans, whereas it's flat for the bottom 20th percentile, during that same time. So, how we reconcile this is going to be difficult. I think, going back to your demographics question, probably the most worrisome, or one of the most worrisome aspects to me, is that every generation born from 1950 and beyond, you've seen sort of their forward outlook or their forward real income wage potential be somewhere between slightly to to significantly lower than their parents' generation. And up until the kind of 50s and 60s, people that are being born in those generations, it had been the opposite, where in America, each successive generation was sort of had a brighter outlook. So I think we'll have to combat that. And just a couple more, just because I think they are really meaningful. When you think about financial assets and what's happening even recently, home values have appreciated by 120% between 1965 and today. Incomes have increased by 19% over that same time. And corporate buybacks in the last 15 years in the US have totaled 7.6 trillion, whereas wages have risen by 4.6 trillion. So, and my dad's an attorney, so maybe he'll be upset with me, but I don't think it's coincidental because I'm really, again, grappling with what changed in the 70s and 80s. And the number of lawyers per 1,000 people was about 1 per 1,000 in 1970, 2 by 1980, and it's about 4.5 today. So you've seen a nearly, almost 450% increase in lawyers. And I think that goes along with, again, that this sort of privileged class has been able to sort of seize the day. And I know people love Warren Buffett, and I keep stepping in hot water probably on this interview, but I think his whole mantra of like asset light investing and low overhead, and I think those things contributed to, along with China's entry into the WTO and outsourcing to companies that really were focusing on profit margins and earnings per share at the expense of workers, or what would be considered asset heavy. And so that will get us into this demographic discussion for sure.